So welcome to this AIM seminar. And I suppose other colleagues will join us in a while, but let's start because my introduction is particularly addressed to the people who don't know maybe the AIM Institute and what we are doing. So welcome to this seminar organized by the Research Center on Artificial Intelligence in Value Creation inside the AIM Institute. And Okay, briefly, what we are expected to do, the Water Research Center, which is the mission of the Research Center on Artificial Intelligence in Value Creation. We launched last year the Institute on Artificial Intelligence in Management with other colleagues, Rutan Wiesing, who is responsible of the Research Center on Work Organization, and Renaud Champion as Executive Director of the Institute. And the mission of the Research Center is mainly to look at the impact of artificial intelligence in value creation. And value creation means the impact on business model and ecosystem, competition in this case, how competition strategy are impacted by artificial intelligence, but also which is the impact on user interaction. So how the consumer and the consumer behavior, how the consumer react with new interfaces, smart interfaces, and new solution. That's why the goal of the Research Center is this, and we increase the number of people who are involved in the Research Center. There are many faculty members who are working on different research projects related to artificial intelligence in value creation. We have also new faculty members, Ajay Kumar and Richie, who joined recently in September, and they are working on specific topics, and also Salma as a doctoral student. But we are also working with research fellow from other university, University of Southern California, MIT Design Lab. We have also Charles O'Faker from Florida State University, so different universities that I can call them satellite, and they work on real research projects, so they are not just names on the list, but they are working on specific research projects, and they are coming here also to share their expertise with seminar or conferences. So the group is growing. And this is, we have opened also a new call for fellowship inside the school to involve other professors interested in looking at the impact of digital transformation AI to work in this field, to enrich our field. And we have also new faculty position that we are opening. Given this, we have launched last year, and it was very successful, this seminar series in value creation. The goal of the seminar series is to invite the top scholar, so not a scholar at the beginning of their career path, but top scholar. And in the past year, we invited different professors who are also editors from big journal. Today, we have Gianvito Lanzolla, who is our star today, and then we'll introduce you properly. To present, to open up the research, to create a new stimuli for us to look at maybe our discipline in a different way. That's why the seminar series is open to all the different disciplines, not just marketing, strategy, entrepreneurship, organization, why not? So this top scholar open up the research. But our mission is also to see and create a link with the practice. This is particularly true for the MBA students, for the executive, who are more interested in looking at which is the implication of artificial intelligence in their daily life, in their practice. And that's why for each seminar we have a discussant. The discussant comes from the company and is strictly related to the topic presented by the top scholar. So today we have with us AXA Innovation Lab. And the topic it will help us to highlight the managerial implication and to open the debate with you. So thanks to both our speakers for coming. And briefly, last year we touched several topics, security and ethics, the challenge of responsible AI, the impact on ecosystem, the emergence of the platform, the impact of the business model, the impact on CRM. So we try to look at how AI is changing the different aspects of in management of the different processes. So we had a very interesting seminar. All the seminars are on our website, and you can also watch them if you have lost and if you are interested in a specific subject. So we are recording the seminar, and then they are diffused on YouTube or on the other campus, and to those who may be interested in going back and watch what the seminar proposes. This year we have another interesting calendar. This is just a draft. The events who are indicated here are confirmed, but maybe other events will be added. So we have for each month one seminar. The next month in November we will have the director of the design lab at MIT Design Lab, talking about the impact of AI in the design. But we have, you see, other important speakers from Texas University, from Newcastle, from Cass Business School today and also in May. So we have a different speaker touching the different topics related to AI. The goal is really to generate the debate and to stimulate new research. So I could say that artificial intelligence in value creation as a research center wants to position in a cutting edge area on the terms of research that could cover and open new topics useful for our proposition maybe next year. And we have with us Christophe de Beauvais in the positioning of the School of AI that EMLYON wants to develop. And I mention also, because it is relevant, very important for us, last week we sponsorized a conference, a very important conference at MIT Design Lab. So it was sponsorized by the Research Center on Artificial Intelligence, in particular AIM Institute. And this conference was at MIT on Beyond Intelligence. And it was extremely fruitful, multidisciplinary, looking at how the designer look at the evolution of technologies inside the products with Internet of Things, so smart design. And then our contribution is to look at more, which is the impact on the managerial outcome and the impact on the consumer behavior perspective. New design generate a better relationship with the brand, generate satisfaction, consumer attachment. So to look at the managerial implication. And on this project, we are working with them. The topic of today, just 2 words about Gianvito Lanzolla. Thanks for accepting to come. He's based in London and is a faculty dean at Cass Business School, and also is director of a research center in Cass Business School. He will talk us more about himself. He's a very, very important scholar working in a strategy field. And the topic he will present today is artificial intelligence adoption and convergence pattern in the financial service industry. Financial service is just a contextual, empirical context of his findings, but of course this is relevant for all of us to try to think how these results, how these observations and insights can be applied in different contexts. And we have also Discussant. The Discussant is Arnaud de BERGH, Senior Data Scientist at AXA Innovation Lab. Thanks. And Arnaud will, at the end of the presentation by Professor Lanzolla, he will open up the debate and he will tell us the managerial implication. So what is implemented in terms of artificial intelligence inside AXA, how AXA is taking benefit, or how AXA forecasts the evolution of artificial intelligence in the financial market. So that's all. I leave the ground to Professor Lanzolla, and thanks for coming here at EMLYON.
Thank you. Good morning. Can you hear me without or with? Okay. Okay. Good morning. Okay. While we set up the presentation, so I'm Gianvito. I'm from. Clearly you can hear from my accent. I'm from Oxford, Italy. It's a new province in Italy called Oxford. So, I studied in Italy. I moved to London in 2001, and I first London Business School, and then I finished my PhD, and I moved just a few tube stops in London. It's called Tube, the underground, from Regent's Park into the city. And I started as a senior lecturer. In the UK, it's called senior lecturer in strategy, and now I'm the dean of the Faculty of Management, which is a fairly large one. We have 80 people, spanning all areas of management, from consumer behavior, strategy, operations, entrepreneurship, organizational behavior, and leadership. So just very quickly, Thank you, that's very generous. I mean, your introduction is really very generous. So I study in my research the impact, the impact of technology, but more specifically digital technologies in strategy, organization, and governance. So that's my research program, and I have published some of this research in Academy of Management Journal, Journal of Management, and Production Operations Management. So different journals related that accept papers that relate to digital transformation and the wider implications. I also work extensively with the corporate world and with MBAs to try to understand whether what we study in academia is also true in terms of corporate. So I do a lot of exec-ed and advisory work in terms of digital transformation for financial services, TMT, technology, media, telecoms, and industrial companies. So the topic of today, I'm just going to speak, so the overall program, research program, is about digital transformation, governance, strategy, and organization. Today, I will focus on a specific topic, which is in between strategy and organization. So the topic, this is a work in progress, so it's not a finished paper. So I'm taking some risk to present a work in progress, but I hope, we will interact on this work in progress. And the title is The Impact of Digitalization and AI on Firms, Business, and Risk Logics, the case of the US and US banks and insurances. Now, this is to activate it. So this is a specific paper. It's also a joint work with two colleagues at Cass Business School, my PhD student Lei Fang and Andrea Tsanakas, which is in the insurance department. So what is the theoretical puzzle that we want to address in this research? So digital technologies, artificial intelligence, have been associated with two potential outcomes at the organizational level. So do they drive convergence, so meaning all companies, all organizations that adopt digital technology become more and more similar, or do they drive even more focus on what is idiosyncratic within organization, hence they become even more divergent. Now, if you look, that's the very high-level theoretical puzzle. If you look at the theory, it's not that the theory particularly helps us in understanding, from a conceptual standpoint, where digital technologies and AI can lead the organization. This is a piece of work that I'm doing with Chris as well. So, if you look at the technical level, so at the technical level, digital technologies tend to be associated with this concept of blown to bits. So everything becomes digital. Everything is the same. Now, I'm going to just come back to this, but everything becomes the same, so much so that some companies even embarked in pretty disastrous M&As. Think about the case of AOL and Time Warner, that in early 2000 decided to merge because everything is digital. We will exploit synergies, and we all know how it ended up. So when we think about blown to bits, so the technical view on digital technology adoption tend to be very positive. So when we digitize our physical artifacts, whatever they are, they become digital. So digital artifacts in this process of digitization and connectivity immediately acquire new attributes, which are pretty desirable. For example, digitization brings everything becomes more granular, you can edit much more, it becomes more replicable, more traceable, more modular. This is something that we often associate with positive organizational and knowledge outcomes. At the same time, when the digital technologies are adopted in the organization, connectivity of digital artifacts drives ubiquity, accessibility, synchronization, speed. This is all good stuff, right? And many people, as I said already earlier on, thought, okay, that's so good, let's exploit it, let's build synergies, let's do mergers, and something beautiful will happen in our value creation strategy. Now, when you go from the technical level, so very down, a little bit more at the organizational level, now digital transformation, AI, are not adopted in a vacuum. They are adopted in an organizational context. Now, if you look at the organizational context, when you adopt digital technologies, there are different things, actually I would even say many things that happen. Now, some changes related to AI, I mean, I'm going to say AI, digital technology, it's interchangeable. When you, at this level of abstraction, when you adopt digital technology in organization, there is, I mean, at the organizational level, there are at least two idiosyncratic outcomes. When I say idiosyncratic outcomes, I mean outcomes that are strictly related to the act of adopting digital technologies. The first idiosyncratic outcome is that digital technology adoption doesn't necessarily bring what many people think more. Let's focus on the horizontal axis. The horizontal axis has two potential outcomes of digital technology adoption. One on my right-hand side, so on your left-hand side, it's digital technology adoption creates even more silos. Because, I mean, it increase cognitive and emotional cost, and organization, people in the organization, instead of starting to communicate more, they actually end up communicating much less. So one potential outcome in terms of knowledge is silos. Another potential outcome is what many people think it's actually the default outcome, more, let's say, communication. So we unleash organizational knowledge, and in the organization people can look for knowledge much more broadly within, I mean, even outside their legacy scope. That's one outcome, which is clearly bimodal. It's not straightforward. I mean, now think about the second one, digital technology adoptions, and here with Arnaud, for example, we have a living example. I mean, Arnaud from AXA is not the typical insurance company person that we would have expected in the past. I mean, in the past we had underwriters, we had people that were doing models, but definitely not data scientists. So what is the point that I'm making? Digital technology comes also with a change in the distribution of competencies in organizations. Now, this is good on the one end, because I mean, when you bring new competencies, you bring diversity, and we know that diversity is good in general as an abstract concept. But then, I mean, there is when you speak, I mean, within the context of an organization, it depends whether these new digital competencies substitute legacy or complement legacy competencies. Now, I mean, even from the setup of AXA, that there is a lab, no? I mean, you call it Rev now, I was taking note before. I mean, you can see already that the legacy part of AXA still operating, Arnaud works in a separate unit, right? I mean, the Rev. So they've already solve the problem, to solve the problem. So the legacy part works independently, and then all the new parts, the new competencies are in this Rev lab, which is the one that is supposed to, I mean, which is helping the organization to transform for the digital age. But not all companies do it right. So in some cases there is just a sheer substitution, and that's the vertical aspects. So if you have a substitution, which is the top end, clearly you create a lot of cost in the organization, which are both cognitive and emotional. Much better the situation when it's seen as a complementarity, which is, I think, the case that AXA is trying to foster. So you can see that, I mean, beyond the very positive technical approach, everything is beautiful, everything is blown to bits, when it comes to the reality of the organization, the potential outcomes are very different. In terms of, you have potential different outcomes in terms of digital technology adoption. And for example, in the context of insurance company, my colleague Paula Zabrowski says that the more insurance company adopt digital technologies, the more they tend to enable these technicalizing forces. So the decision is made on a very technical ground, as opposed to contextualizing forces, whereby you make a decision based on the knowledge of the context. So you can see that, in this case, convergence, divergence is not a straight, it's not black or white. It's really about shades of gray to see where the organization might end up because of the adoption of digital technologies. Now, we have seen at the technical level, we have seen at the organizational level. What does it happen at the strategic level? Now, this is another study that I did with a colleague of mine. We studied AXA Springer, which is a large German publisher. And in Europe, they claim at least they are the first digital publisher in Europe. Now, AXA Springer, in 2003, you can see, they started, you can see on the first corporate chart, in 2003, AXA Springer claimed that they wanted to become digital, okay? They started. Now, if I was to show the 2003 corporate chart of AXA Springer, would you even remotely guess that this is a publisher? What can you read in this chart? You can read market leadership in German language, which doesn't mean anything. It's very general. Internationalization, digitalization, making money, and then a bunch of corporate values. Clear? What does it happen 10 years afterwards? That digitalization disappear, or better, becomes the context. See the upper part, paid models, marketing models, and classified ad models. So digitalization has become now context, but what is now back at the core of the organization? It's not making money, but is. So what is the outcome that we are observing here? Digitalization at the beginning looked like it was about AXA Springer go everywhere, but then almost paradoxically, they are reverting back to their core competencies. Clear? But now you could say, okay, fine, that's not even clear cut, because now if you look more broadly, there are other companies that are using digitization, on the contrary, to foster convergence to the extreme. Think about the case of Amazon. Amazon is actually trying to go for, this is just a famous economist cover page, go for domination. If you look at the value chain of, for example, of the shopping world, so how does it work? When we want to shop for something, first of all, we need to get out from our houses, so we need to unlock our locks. Now, then Amazon is trying to make our locks smart, because once locks become smart, you can get out, but you can also get in the shopping whenever you want. Then, of course, you need to have everything connected. You need to have cloud to analyze all this wealth of knowledge and information that you have to that you put into the organization, into the system, the platform, and the services. So, what is Amazon doing? Amazon is trying to control all these steps of the value chain. Okay? Everything will be converged from your shopping experience will be all converged in one platform. And you can book you can reserve and order your dinner when you are going back home, and then you will find it already at home. Well, maybe not on the table, perhaps that's the next step, but you will find it already on the doorstep, because I mean, your lock, your smart lock has been opened by the Amazon delivery guy. So that's actually the opposite in terms of the outcome of Axel Springer, which went for divergence. Here we see full convergence, everything on a platform. So we have seen the technical level, we have seen the organizational level, the strategic level. What does it happen at the institutional level? This is another paper that, I mean, this is just another slide to show the extent and the scope of this convergence. I mean, all these sectors that once were completely disconnected, now they are becoming part of the Amazon ecosystem, okay? So what does it happen? And I mean, it's just another slide to show the same point about convergence. Now, what does it happen at the institutional level? So we have started very micro, and now we are going very macro. So if you look at institutional theory would say, listen, when there is, first of all, institutional theory is not very, let's say, very advanced in terms of understanding how where legitimacy comes from in periods of technological change. Anyway, what institutional theory would tell you is that companies, when they adopt technologies, they should do it because there is an expectation of legitimacy. Okay? So they adopt technology not necessarily for rational reasons. They adopt because, I mean, AXA is adopting, so Generali is also adopting. Okay? Generali maybe has not even seen why AXA or Aviva or Zurich are adopting. It's just, I mean, for legitimacy. Clear? So there is, but the point is that, I mean, what kind of legitimacy is important in periods of technological change? Now, the typical approach is a structural legitimacy. Organizations must adopt because they want to be like their peers, and this will drive in a way or another some kind of a business bottom line result. But you know better than me, because if you are here, there is clearly self-selection, that when you adopt AI, the leap between adoption and performance, it's long and quite uncertain. So institutional logics driven by structural legitimacy cannot explain the adoption of this kind of technologies. Clear? Because, I mean, intrinsically, you are taking a big bet. You don't know. So what is emerging, we have a paper with my colleague at King's, Igor Filatochev. We are studying what are the types of logics that emerge during periods of technological change. And what we see is that companies that adopt AI get a Tobin's Q premium. Tobin's Q is a measure of how much a company outperforms their peers in the stock market. So they get a premium if they are aligned with the expectations related to the current technological changes. So basically, there is now a lot of expectation that AI will be the next big driver of business. Doesn't matter that short term it doesn't drive results. You need to do it because in the long term, if you don't do it, you will lose not only you will lose not only your advantage, also your competitive parity. Clear? Now, you might think this is obvious, say Gianvito, why you are wasting our time. That's not obvious at all, because I mean, all corporate governance, both in the UK and in continental Europe, as they call it, as they call us from the UK perspective, so it's driven by structural drivers of governance, not cognitive drivers of governance. Okay, it's not trivial at all. I mean, companies, boards, if they are not informed that digital technology will be the next driver of success, will block all initiatives that are driven, that are based on AI, digital technology. Because they will say, okay, I don't know what's going to happen. I don't know whether it will happen, when. Doesn't matter, so they will stop it. Clear? So if you look, I mean, if we summarize all these results so far, the theoretical puzzle it's even more puzzling, because I mean, some forces seems to be driving a convergence. So the blown to bits one, at the technical level, or the technicalizing. The more we have people, sorry Arnaud, and feel free then to revert back. But see, Arnaud, I mean, you studied computer science, I guess, no? Yeah. So Arnaud now is a computer scientist in AXA. There are thousands of people in computer science, in General Electric, in France Telecom. I mean, they were not exactly the typical competencies that you had in France Telecom 20 years ago. You had telecommunication engineers, not data scientists. So technicalizing would bring convergence, because we would have people in computer science basically everywhere, from telecoms, that's the story of Time Warner and AOL merger. Ecosystem, so the story of the ecosystem of Amazon taking over everything, digitizing everything, and converging everything on one platform. Or cognitive legitimacy. Why cognitive legitimacy drive convergence? Because I mean, now there is, if it was, I mean, structural legitimacy would imply that companies, structural legitimacy, keep doing what they're doing, because that's what they know. That's where they can perform. That's where there will be the results. Okay? So structural legitimacy would drive divergence, even more divergence. Cognitive legitimacy says in the long term, if you don't have AI in your organization, you are doomed. That's why this is a force for convergence in the business sector. And divergent contextualizing, focus on idiosyncratic resources, that's the case of Axel Springer. So now you would say, okay, fine, we started with the puzzle, and we are, after a few minutes, still dealing with the puzzle. So since it's so puzzling, I said, okay, let's go and collect some data to see what's going on in reality, okay? So now I'm going to start speaking about the case of the US and banks, US banks and insurance companies, okay? So what we did with Andreas and Lei is, okay, so listen, let's see what's happening I mean, in banks and insurances in the US. I'm going to explain you first the database, and then I will tell you what is the study. So the database is about, I mean, we tracked all companies that are listed in the New York Stock Exchange from 2006. So there are roughly 930 banks, 200 plus insurance. So the total is then if you do, this is a cross-section times the time series, we have around 7,000 plus observations, okay? And this is the breakdown of the different companies in the database. You can see it's fairly, I mean, all different subsectors are represented. Of course, there is a strong, let's say, prevailing part of holding banks, which we control for to see whether they bias our results, okay? So I'm explaining, first of all, what is the empirical context. Now, how do we collect data? Because I mean, we need to have very granular data over a very long period of time. So what we do, we take, I mean, the 10K. The 10K is a document that all companies, it's something that looks like this. I mean, so it's a document that all companies that are listed in the New York Stock Exchange every year have to submit for compliance reasons, okay? Now, in this document, which is a fairly thick one, there are different sections. We focus on two sections. The business section, which is where the organization, where the company explain the way in which they operate, and the risk section, which is where they explain what kind of risk they perceive and how they deal with this risk, okay? These are business and risk are, I mean, so operating model and risk are two very important dimensions of any organizational life. So that's why we start from these two different sections. Is it clear so far? So we have created now, with a lot of hand work, this significant database. And now, what do we want to see? We want to see whether, let me start from the dependent variable. So, and then I'll go back to the control variables. So, we want to see whether over time, because of adopting digital technologies, banks and insurances becomes more or less similar. Now, we measure similarity in terms of the way in which they write about themselves in the different business and risk sections. Clear? Now, since, remember, the initial question was about divergence versus convergence. It's never going to be black and white, it's going to be about gray. So we develop a measure of blurring. So how do we measure blurring? We have trained an algorithm to recognize banks and insurances, okay? Once we have trained this algorithm, then we run again the algorithm after training the algorithm on the different 10K that we have, and we ask the algorithm, Miss Algorithm, is this risk section of a bank or an insurance? And what is your confidence level? Clear? So, the algorithm can still correctly classify that piece of information as a bank, but go from 90% confidence to maybe 50%. So to bring to life this operationalization, I'll show you some data. So, for example, there are two axes here, true type and prediction, okay? So you can see 2006, 2018, and it's all symmetric. Now let's focus on the first quadrant. True type insurance, so the piece of information is insurance, okay? We let the algorithm go through our database, and you can see clearly that over time, the confidence level of the algorithm in classifying insurance as insurance, or banks as banks, and all other intermediate cases, insurance as insurance clearly goes down. We go from around 80% to less than 77%. Can you see? Same for banks. Where are banks? Banks predicted as banks is this quadrant, goes down from 82 to less than 75%. At the same time, there is the flip side, the flipped effect. Banks recognized as insurances, and you see, it goes from 19% to 25%, and insurance as banks, it goes from 20 to 25%. Now, this is, we can question the methods, and I'm very open to any comments on the methods, but if you trust the way in which we have trained our classification algorithm, and we might have made mistakes, I don't know, but we hope we haven't. So this is objective, okay? That's, what comes out from this classification algorithm. We also then look at the different subsectors, okay? Because we say, okay, fine, this is very macro, you are capturing a lot of variance, let's go and look within. So different sectors of banks, subsectors of insurance. Now you can see, for example, life, I'm gonna focus just on one. Life predicted as life goes down. So, and you can keep looking, for yourself. Now, not everything is exactly. There are some cases that reinsurance, predicted as a reinsurance, it's not a very clear pattern, or investment bank investment bank as investment bank is also not a clear pattern. So there are some subsectors which show a much less clear pattern. In fact, we are trying to understand why that's the case. And I'm going to anticipate, our idea is that there are some sectors where knowledge is so idiosyncratic that digitalization, artificial intelligence, to some extent resist the injection of data scientists, and the legacy win. At least, I mean, is still winning. Clear? So we look at blurring, and this is basically the description of our dependent variable. Please.
Excuse me, I have a clarification.
Please.
Question. So the training set,
Yeah.
wasn't it split by year? So wasn't it different training
Yeah.
every year?
No, the training, yes, we train every year, and then we plug it back, yes. Yeah. We honestly, we tried, I mean, my PhD student is very good in this. She tried so many other specifications. We also went to much more advanced natural language processing approaches. The results, it doesn't matter how we do it, they're always the same. So these are very easy and intuitive, that's why I present this one. But we have robustness checks of many shades and forms. But thank you for the question. So now, how do we, let's go back now to the models. So, I mean, you have understood it from my earlier analysis of the literature, so I have to speed up. So that understanding convergence, divergence, understanding blurring, it's not unidirectional. There are different drivers, okay? So, of course, I mean, you would say from corporate strategy 101 that blurring depends on the extent to which a bank or an insurance is diversified. So we need to control for diversification. That's, I mean, or you could say that, I mean, it depends on the size of the balance sheet. The bigger you are, the more likely you are to say something that refers to something else, you know? So you can blur. Or now in corporate strategy, in corporate diversification, there is a variable that says that predicts diversification. So it's a little bit endogenous with ROE, return on performance. So we measure performance to control whether there is an effect of better performing banks and insurances on blurring. Of course, now this is a very interesting period, the 2006-2018. It's very interesting not only because there is a lot of adoption, but also because there is a significant other effect related to regulation, right? Because up to 2008, there was a period of deregulation, right? And then, I mean, there was the financial crisis. 2008-2012, there was a period of re-regulation. 2008-2012 is a period of shock. It was not clear where the regulation was going. 2012 onwards is a period of re-regulation. So we control for all these important factors. Now, how do we measure digitization? Okay, because that's now to measure digitization, we did several things. Because I mean, first of all, we developed with experts a list of all technologies that are part of the digitization, let's say, toolkit. So, distributed ledgers, artificial intelligence, and all subsectors of of artificial intelligence, deep learning, machine learning. Now there is also the new. Yesterday, a colleague of mine from computer science was telling me that there is auto machine learning. Apparently, there is a new evolution of machine learning that learns by itself. So that's the new one that is happening. So first of all, we developed a dictionary of all technologies, okay? Then we clustered them for categories, and then we asked another panel of business experts, because the first round was about technology experts. The second round was about the business experts, okay? So we had a list of keywords, and then to measure digitization, we do the cosine similarity between this list of keywords and the text. Clear? I mean, it's a fairly straightforward. It's a much better measure than just counting the frequency. Now, you would say in this context, which is AI, what I can tell you is that, I mean, we broke down the measure. I mean, this is an aggregate one, to be fair. to be honest. It's a measure of where we capture all technologies. But it doesn't matter if you want to look at the effect of AI or distributed ledgers or whatever you want to look. I mean, all these 34, 35 different technologies, it doesn't change. Clear? These are more robust results, and I think it's also, because even saying AI in isolation, you'd never adopt AI by itself. There is also always AI with something else. So that's why I'm presenting the results that are aggregate. They are not by technologies, but we have the breakdown. So if you are interested, I can show you any other specific breakdown. The patterns are very similar. Okay, let's go to the results then. So the dependent variable we have said is blurring, and we are controlling for several things. Now, I'm going to present, being an academic, also I need to present some regressions, otherwise you get upset. I have the 2 by 2. So that's one box is ticked. The second one is about a regression. So I'm ticking also this box. So we estimated the models with random effect, okay? And we do all the tests. Random effect perform better than fixed effect, so we keep the random effect. Now, the important part is what I will show you later. But I'm going to start reading the models, and then I will bring you to the important part. So look, here there are 8 models, okay? There are 8 models, and each model is actually, there are 4 models, because the 8 models are estimated twice. Once for risk, and once for business. Can you see? So what does it mean? We estimate exactly the same model for the risk section and for the business section. Clear? And so far, these 8 models are models with all control variables. Now, I bother you for 30 seconds just to show that, look at what is in this red box. For example, Arnaud, before we were discussing, he was saying that, I'm not completely sure that, blurring is happening in the same way across all different subsectors of insurance. Now, if we trust these results, you can see that, yes, there are some differences, but overall, there are some differences, okay? But overall, the time trend, this is a time trend, it's not the effect of digitization, because it's a panel. So the time trend of banks and insurances is mostly, it's in many cases towards blurring. So investment banks show clear example of blurring. On credit banks, a little bit less, it's minus. Now look at life insurance. It's actually, there is no time trend. For property and casualty, there is no time trend. For full line, there is a negative time trend. So full line insurance actually, in terms of time trend, are not converging, okay? But then, that's not what we are studying. We are studying what is the impact of digitization. So we need to go and see what happens when digitization is entering into the models. So this is just to give you context that there are some differences at the level of sectors. But now let's go and look at what happens when we enter the variables, when we enter the variables of interest. Now, first of all, so the variable of interest is digit cyber, okay? We call it in this way in Stata. Digit cyber, so the extent to which companies digitize as measured as cosine similarity, it's always strongly positive across all models, both in the risk section and in the business section. Clear? So this basically means that the effect per se of digitization or blurring is positive and significant. Okay? Now, yes, we need to also do the interaction effect. That's a different story. But in terms of baseline effect, this is strongly positive. What I think is is interesting is not just the positive one, is that it's positive both for the business and the risk section. But now, what I think is more interesting is that, I mean, look at the effect of, the interaction effect of shock on digital. So when we break down time into shock, re-regulation, I mean, actually, that's a dummy. So the baseline is deregulation. So here, shock is the extra effect vis-a-vis the baseline of deregulation, and re-regulation is, I mean, is another dummy compared to the baseline of deregulation. The interesting thing is that shock times digitization, it's not significant for risk, while it's significant for business. Are you following? Then re-regulation digit is always significant, whatever it is the significance level. What does this mean? I mean, what does this mean? This means, I believe, a few potentially interesting things. Okay, one is that there is blurring. Okay. Second, and perhaps even more interesting, means that blurring doesn't happen at the same speed in all parts of the organizations. The fact that digitization times shock is not significant in the risk sector, it means that the organization, as far as risk management is concerned, is not yet reacting to digitization, while it's reacting in the business operating model. Clear? So the results, I think, is I mean, as it is so far, we find evidence that digitization brings to blurring. But we also find evidence that digitization is not neutral vis-a-vis the different business sections of an organization. Specifically, the effect of digitization is asymmetric, and some parts go faster than other ones. Now, this is not just an academic, let's say, embellishment. This is actually has a serious organizational, strategic, and policy implications. Because from an organizational standpoint, it means that organizations that adopt digital technologies, including AI, go at different speed in their business logics and their risk logics. Which is, I mean, a driver. I studied Thomas Cook. I don't know whether here in France has been featured in the press. And that's exactly what was happening in Thomas Cook. I mean, that's a qualitative study that I did for a previous piece of research. They were exactly going business. I'm going to report a quote. When I interviewed the executive and the employees, they were telling me, in the last 7 years, we have changed strategy 7 times. Okay? 7 years, 7 times. At the beginning, we wanted to take on Expedia. Then we wanted to become a luxury, well, we want an airline company. Now we want to be a high-end provider of tourism. Now, the business was going at at this pace, but all organizational structure were lagging behind massively. The marketing manager was saying, I have been asked to sell more, but I cannot sell because, the technology guy is not giving the platform. So I'm getting frustrated because, the technology guy on the other end, it's all spending capex in embellishing the technology, but it's completely useless because it doesn't work on the user experience. So we are diverging. So this, let's say, these aggregate results, when you break them down into in the reality of the companies, show that actually they are reflected pretty neatly. So the story that I'm telling today is that digitization empirically drives blurring. blurring doesn't happen at the same speed in all parts of the organization. And that's perhaps why, in an abductive logic, there is so much confusion about what drives what. Because, I mean, we need to understand a little bit better. Maybe the technical level applies, the technical explanation to a level in the organization, while the strategic one to another level of the organization. So the different competing forces, they seem so confusing because, I mean, we are applying them to the same dependent variable, while we should break it down at different level of an analysis. That's basically our theoretical insight so far in this paper. From the policy standpoint, and I don't know whether there are people that do policy here, and I was at the Bank of England a few days ago discussing these results. From the policy standpoint, what is emerging is that bank insurances that once upon a time were seen as independent, they are becoming increasingly more blurred. So I'm going to have some water. Yeah. So they are becoming more blurred, and this basically means that will be more systemic risk, which then will require a different way of regulating banks' insurances, because blurring in a way or another means compounding of risk. If these results are to be taken seriously, we need to start looking at also at the regulatory level how we can how we can regulate two sectors that once were considered disconnected, okay, and increasingly are becoming, more and more connected, okay? So thank you very much. Sorry for my, sorry for this silly cough that I have. Thank you.
I have some slides, but I won't use them that much. Yep. Okay, so I'm happy to be here. So I'm part of AXA Rev, which is an innovation entity of AXA, responsible for all the data-related topics, AI data inside of AXA. It was created 6 years ago. So initially we were just 10, and now there are 100 people in this team. We are present mostly in Paris. Also we have a lab in Lausanne, in Singapore, and also some guys in San Francisco. So basically, it was created 6 years ago. It was an initiative. It was the AI movement was it was a bit the beginning, and the president of AXA decided to start this journey. We didn't really know at this moment what was what we will get from this such type of lab. And so initially, the first years it was mostly experimenting, doing some POCs. Then we had the phase of trying to industrialize the proof of concept, and now we are more in a more mature step. So I will explain a bit this journey, because I think it's interesting to understand how companies are entering to this AI gold rush. And for in any gold rush, there are always some excess and some errors that are done, and we made a lot of errors, and so I would explain you some of these errors we did for AI adoption. So maybe to explain you a bit what we do, except this beautiful animation. Yep. So I will use the keyboard. So we basically AXA, it's a very siloed company. It was built with a lot of acquisitions. So we have a lot of entities who have their own autonomy. So why having a group entity responsible for AI? So basically, the entities, they have their own business to run, and so they all AXA entities have data scientists inside. They have the data teams, but their teams are mostly focused on business-related topics, on day-to-day business, like for example, reducing your customer churn. And so data scientists are responsible for building models to predict churn and take actions based on that, or to improve pricing done by actuaries. And the idea of having a group entity is to tackle AI and data issue that the entities cannot tackle because of this of the innovative return on investment, which is not which is harder. It's harder to define initial KPIs for the project. So the team and the AXA Rev is responsible for more exploratory topics, and also putting in production data products and shipping them across all the entities. So taking some knowledge and taking some proof of concept that were done in one entity and then shipping it everywhere in all the AXA entities. And so for example, we have a team dedicated on fraud analysis, which is building a platform to analyze, to predict the fraud, insurance fraud. And there is a product which is used in multiple AXA entities. We have an entity where I'm working at the moment, responsible for building a telematics platform, so to leverage the data from IoT devices coming from the cars, for example, then analyzing it, producing some scores, and then doing some discount for the users, or some recommendations for the users. And we're also exploring some marine topics where we have to monitor containers on cargoes, so to bring some transparency through data in the insurance businesses. We have some topics on contracts modelization. So, as you know, an insurer, when you're buying insurance, you're getting a policy contract, and it's something which is based on paper. And then when you have an accident, then you have some claims management system that will go through your coverage, looking at the accident, trying to see if you're covered or not. So there is a lot of manual work that costs a lot for AXA. So a lot of persons think that for an insurer, the value of data lies in a better improving the pricing. But as an insurer, we are doing some mutualization of risk, so we cannot spend all our efforts on improving the pricing and having something very, very granular. But a lot of value from data comes from improving our internal processes and being more efficient to process claims faster, improving our call centers, all our network of partners that are involved in the insurance value delivery, like managing our network of garage for motor claims, network of hospitals, network of experts. And so there are a lot of processes that can be improved through the use of AI, and that's some stuff we do at AXA Rev. And also being able to model contracts lets you take automated decisions. Like, for example, if you have a car accident, you can directly see from your model contract if you're covered or not. And so if you're covered, then we will directly analyze your some visual, some pictures of your damaged car to see what is the severity of the accident. If it's a high severity, then we'll send an expert. Otherwise, we directly pay the customer. And so we are improving the cost. And so that's some use cases. And then we have also other use cases on NLP, chatbots, document processing. So there are a lot of AI topics that we cover, and we also have some research projects. We are working a lot on AI ethics, model explainability, and we have also a team dedicated on managing the community of CDOs inside of AXA, so Chief Data Officers. So we try to to push best practices on how to manage data, how to document the data inside of AXA to make sure that when we have a new use case, we are not facing a bunch of non-label data. In this case, we cannot do anything. So a lot of persons think that when I have a data project, I'm just going to send my data to the data scientist, and then the magic will happen. But in practice, you have the data scientist will spend lots and lots of hours trying to understand the data, the business rules, trying to fix some data, some missing values in the data. So there are a lot of best practices in data management that we're trying to and we're trying to educate entities to have a better data management, and also to know what should be done for different use cases. If we should use AI or just classical business intelligence to cover the issue. So as I was saying, we started 6 years ago. So before there were already some data scientists, and AXA as an insurer has always been data oriented. As an insurer, we have actuaries who are every year and on a regular basis analyzing the historical data and try to update their pricing models and trying to refine to better segment the risk and avoid to have one price for everything. And so, but there were the arrival of all this new type of data, unstructured data, for example. We decided to build this lab, and so initially, as I was saying, we were a bit exploring, and I think we see a lot of companies who create their own data lab, and so they hire they hire some data scientists, some data product managers, and say okay, now we have to find some use cases, and there are the first years of this process are always so we are always. They often lead to some. I wouldn't say a useless project, but there is a lot of fail fast where you are experimenting. You are also building your infrastructure to be able to leverage this data. And for example, for our different platforms, for the fraud detection platform that we have, we started 4 years ago. Initially, it was a small POC that proved very great results. We had better models than what the entities were already using, and so we had models that predicted the fraud probability better than the average and better than solution on the market. But then when it came to putting it in production, that's where the first issue appeared. So first. AXA, you have a lot of siloed databases. There is not one central data lake where all the data can be accessed easily and where you can build models upon of it. We have started to build it step by step, but it was not the case initially. So the data access was an issue, and also another issue. The issue is not building models. That's always something. That's always a small part of the whole process. And when you have a bunch of data scientists, even a small and simple model can bring a lot of value. But then the biggest issues are accessing the data, transforming it, understanding the data, to make sure that you are not trying to predict stuff on garbage data, and then also. Ensuring that the output of the model are adopted by the business and that you are connected with all the existing legacy systems inside of a company like AXA. And so building the interfaces, the APIs, and then training also the entities and the fraud handlers to use these systems was really hard also. So that was we encountered a bit of we encountered a lot of production issues, and a lot of projects were killed in this middle step of our journey because of we did not expect that. We thought initially that we have great models, we are going to put them in production and the value will come right away, but it wasn't the case. And so now I think we focused on some core problems like fraud detection, telematics, contract modelization, and other machine learning and AI topics. And we have dedicated feature teams who are working jointly with the business. So it's we try to work side by side with the business to make sure that we understand well the data, that we are not building some fancy models that will never be used in real life. So that's these are all the challenge we face in this organization. And there is also a lot of training that we do. We organize a lot of training sessions to, for example, train the actuaries on this new machine learning and AI methods. So actuaries, they are basically using technologies like SAS or Emblem to create their models, and so they are not really used on the type of unstructured data that can be used to improve their models. And so there is a lot of training that we organize inside of AXA to make sure that AI can be adopted step by step. So I think it should be mostly a discussion with you, or yeah. Yeah. So do you want to come on stage also for?
I think that you have confirmed what basically I have modeled in the 2x2. So I'm an academic, and so you have brought to life what is basically the systematization of what happens. So, and then the issue is that what happens to the organization, because the topic here is value creation, no? So what we are seeing is that the value, or the scope of the firm, let's say put this way, might be hindered, might be affected by digitization, depending how you do it. That's basically, so I think empirically, phenomenologically, you confirm what the study has identified.
And I think AXA has an ambition to become a tech-led company, and so I think it's part of all the strategic plans of all the big companies. And becoming a tech-led company, a lot of processes become similar across companies, and we try also to create some bricks, as you were like the bits that you were mentioning, to make sure that all the processes we have inside of AXA can be connected, and that when we are shipping like a new fraud engine, we can easily reuse some bricks, and when we want to ship it in a new entity, we don't have to reinvent the wheel all the time. So therefore, we are trying to have this type of bricks inside of AXA, and but yeah, we are still not yet a tech-led company. And on your point regarding the convergence between banks and insurers, so I've worked a lot on data partnerships between banks and insurers. So historically, banks were mostly distribution partners for insurers. There are a lot of banks that propose some insurance, and behind it's AXA who is holding the risk, and they are just getting a percentage of the premium that we sell. So I think, and based on all the projects that are led inside of AXA, I wouldn't say that we are trying to become a bank insurance, and it's clear in the strategic plan of AXA that we want to put aside some banking, some investment, or some business parts that are closer to banks. But I would say that we are trying to focus on our core value, which is helping customers in case of accidents, or but we are trying to work more with banks. We are not trying to do what they're to replace the core business of banks, but more to try to connect with banks. For example, we are doing a project with ING at the moment where we are getting all the data from ING customers, and we are merging it with AXA customers, and by crossing by analyzing the crossed the merge data, we are able to propose new services and to better target the customers. For example, when you look at all your daily transactions, there is a lot of value that can be used by an insurer, for example, to propose you products that make sense. For example, if we see that you have bought a new car, then we can push you some discount for motor insurance, and we can also help you. We can also try to predict your health risk based on your daily transaction. That's something we did, and then propose some simplify the process of getting insurance. So I don't know if it answered your.
What you're bringing evidence
Yeah.
that there are dynamics. I mean, phenomenologically, the convergence is happening.
Yeah.
Not at 360 degrees, but it's happening in many parts, which is basically what the data are capturing. These are US data, but I think the trend is similar.
Yeah, totally.
It's happening. So that's basically what is scary, I think, is the fact that it's not happening at the same time in all parts of the organization and in the regulator. And that's the difficult part. I mean, now from let's say business standpoint, because then, like in Thomas Cook, creates drifting forces in the organization. The board thought that they were doing Expedia, and when the company was still selling, let's say, cheap holidays, or the board thought that they were doing airline company, and where they were still catching up with the Expedia model, or now the board thought they were a company doing luxury tourism, when the company didn't know what they were doing because they were all over the places. Which is from the MBA people, if there are any MBA here, that's a massive problem. Because I mean, in terms of strategy, organization, incentive, how do you incentivize? How do you keep together an organization that is going at different speed?
I have a question, talking the microphone for Gianvito. So we are studying exactly this phenomenon of convergence, divergence, but from the merge and acquisition point of view, with the double helix model. So I see that you don't look at specifically the merge and acquisition, but maybe an explanation of an explanation of the convergence divergence that you observe in your results could be also related to the fact that they acquire similar companies or this.
Diversification measure. I mean, I went very fast. In diversification, in the diversification measure, we also it's another cosine similarity, and there is a merger acquisition. So we capture. I mean, not precisely, but I mean that measure of diversification captures the level of M&A, of acquisitions. We don't capture whether they are acquiring in that what they're acquiring, but we are somewhat capturing the activity around M&A.
It's confirmed, double
helix? The double helix, to do that, I mean, empirically, we need to do to interact diversification with time, which I haven't done, so I cannot answer. Okay.
We find some correlation.
Okay.
That could be synergy.
Okay. I didn't, because that's not the focus of the current study.
Yes, no, yeah.
To answer your question, I should have interacted with time, which I haven't done.
No, perfect that you have not done this. Otherwise, which is the originality of our study. Yeah, but maybe could you explain also in part by the competition effect, the tendency to be similar to my competitor or dissimilar?
Yes, I mean, that's in a very
broad
black box we put in diversification, which is basically the extent to which they explain, they say, we are diversifying, we are acquiring, we are merging, we are this, we are that.
Yeah.
So it's a loose measure, but at least we capture something.
Perfect. And I have a question for Arnaud. It is an open question, just to know your opinion. If you have some metric measuring the impact of value for customer in the marketing or in the different processes where data is, or artificial intelligence is adopted, there are some standard metrics.
So we spent some. It took some time to properly define some metrics, because initially when you're just doing innovation, your boss tells you, okay, you have no ROI. You just try things, and then we will see later if it brings some value. But then for step by step, for some specific projects, especially projects on fraud, on telematics, on claims cost optimization, we try to define some KPIs for to assess the impact of these new data products that we are shipping on the business. And so it's always hard to define a KPI, and it's not hard to define a KPI, but then to properly measure which part is due to the data, to these new data models, and which part is due to the pure business performance. But we definitely for fraud, for example, we definitely have KPIs on the. I don't have the figures in mind, but for the improvements of fraud detection that we have built, the improvement that occurred through these products, and then when you define these metrics, it's important not to just focus on the model performance, but also to define some metrics that are related to the revenue, and because, for example, for fraud, when you are if your metric is just a number of fraud that you detect. Okay, but then all these new cases of fraud, they have to go through fraud handlers, and the fraud handlers, they can just handle like 50 cases per day. And so if you are sending them much more cases, they won't be able to analyze that. So the final KPI should be the claim cost improvements that was reached through this data product, and we have seen really improvements of that, because we have been able to test it multiple years and to compare it with a solution on the market, and so.
KPIs could be like goal conversion rate or the cost per click, like the bounce thing.
It could be. In your looking at some online KPIs, so we are not at Rev. We are not working on on marketing topics, like how to improve ads of AXA and improve our website messages, but it could be. But then just measuring, in data science, if you just measure the click on ads, for example, it's also important to link it with some real value, like did the person purchase the product after, because it can be a good indicator, but there are multiple KPIs that you need to take into account, and also you also need to see if the investment in the technology and in the people to run this data product is worth the improvement that you get. If you just get a small percentage of improvement, and the product is costing you millions to run, because you need to have data scientists, DevOps engineers to run the platform, product managers. So then we could say that even if there is an improvement on the KPIs, when you compare it to the investment, it's not worth pursuing. So we have some projects that we stopped because it was bringing some value, but then the investment was not worth it for in this case.
At this point, what kind of projects had a greater return on investment?
A greater return on investment, I would say in our case, fraud, the fraud projects. Then we have some very simple projects, and sometimes the simplest projects have the highest impact. Like for example, it's not something specific to insurance, but procurement, for example. Any big companies, they are working with a lot of partners, and so when you say partners, you have some contracts, some POs, some invoices, and just being able to link all these documents together and have a 360 view of your partners and how, for example, AXA France is working with a partner, but AXA Germany is also working with a partner. And just being able to link all these data together, you can do a lot of optimization, and you don't need to have a complex data science model or even an AI that will automate some stuff, but just being able to link these data together brings a lot of value, and it brought a lot of improvement with some stuff running in production. And the main issue is being able to link all this data, and that's one of my points. The data access, data cleaning part is always the most complex part in the data journey. And when you have for example, some invoices, some contracts, you don't have an ID to join these documents together. Then in one invoice, it could be with EY, and so it's titled EY. In another contract, it's Ernst & Young, and so you say, oh, how can I merge these two documents and see if what was contracted was also has been seen in the invoices. So is sometimes bringing more value than a machine learning model that is producing some scores. Like for fraud, it brings some improvement and some value, but sometimes the simplest projects are better. And when we start an AI journey, we always want to go to fancy topics like image recognition, and we forget some legacy topics and business improvements that could that could bring some much more improvement. Yeah.
I have two questions. One for you, Gianvito, and one for you, Arnaud. Regarding the issue of divergence versus convergence, don't you think that within companies there is still the magical thinking regarding all digital technologies? Because many managers think that since they have the technologies, it will work by itself. And conversely, do you think that there is still this magical thinking regarding strategy, the implementation of strategy? In many companies, I used to be a practitioner before becoming coming to academia, and I felt that somehow, since strategy has been conceived, it should be implemented naturally. But the digital technologies prove that it is not possible. And I think that the expectations regarding the digital technologies in most companies are cost-related, as you illustrated it. But I think that the best contribution that your technologies, your projects can have is in terms of internal operational performance, because the first clients that companies have are internal clients. And I think that if companies are able to have the big picture of all their processes thanks to AI, that would be a very good improvement, don't you think?
So I have a model. Which one? Oh, sorry. So there are. So the way in which, let's say, I don't want to call it maturity index, but the areas, if you observe phenomenologically where they are adopting and using, there are 4 areas. One is optimization, operation optimization. The other one is value curve innovation or modification. The third one is customer engagement or omni-channel. And the fourth one is employee engagement. Now, this is very much as is adoption. and I'm not 100% sure what AXA is doing. I mean, it's you don't go and challenge the existing assumption about your strategy, your position. You keep them, and then you optimize operations, you engage with customers, you do more. I mean, you use technology to do these things. Where technology is really transformational is when you use these technologies to redefine your business model. Now, when insurances wants to become platforms, when Apple becomes healthcare, when Class is a tractor manufacturer, becomes your personal assistant rather than a tractor. This is basically it's a transformation of your value proposition based on needs, not on core competencies or on products. That's a radical departure from innovation to transformation. So what we see is that many born digital companies are managing to do the transformation and building value proposition based on needs, while legacy companies are failing. So they are doing more and more, they are adopting technology to adapt to this world, but they are not really leading in the transformation. So the risk, for example, for AXA or for the likes is not that much that Zurich will eat market share, but that Google or Facebook, they will understand the consumer behaviors so well that they might decide, to give this full value proposition. Is it magical thinking? Is it? I don't know, but that's what we see in the data.
Yes, multiple points on that. On the maturity part, we spend a lot of time at AXA Rev defining some maturity metrics for all the entities of AXA. And so we are present in everywhere in the world, and so we have big entities like AXA France, for example, or AXA Germany, and also we have small entities like AXA Brazil or AXA Poland, and so for this type of organization have different issues to tackle, and so we are trying to define what are their level of maturity on the data, on the core competencies they have inside, and so do they have some data teams already? What type of project they did, and so then we are able to take the right decision on what should be done with them. If it's just doing a data mapping, it's a first step of the journey. Trying to map where is the data. Are we able? Do we have data dictionaries, for example? Do we know where what is in the database? It's a first important step to have, and most of the time there is something quite sparse. So that it's true that we cannot you cannot say, okay, I have this awesome product, I will ship it everywhere in all the entities, and it will work. If you do that, it fails all the time. But then, yeah, it's true that we want to. I agree with you with the fact that our competitors are not the other insurers, but mostly tech companies who already have all the core processes to quickly launch new products, and they spreading the agile methodologies inside of AXA. It's quite hard. It's not something very familiar for everyone, and for a lot of use cases, we say, okay, we won't build it internally, and we will work with startups, with other more tech-led companies to leverage their technologies, their products, and then AXA is bringing the risk the risk assessment. AXA is pretty well known for having good solvency, the metrics, and so it's more like a risk carrier for some use cases for these new insurtech businesses, so yeah, it's we want to become a tech-led company, but we know that at the size of a company like AXA, we won't be fully digital, could be an Amazon or a Google. So there are some sometimes the make or buy decisions needs to come, and you have to know if you want to build it internally to own all the IP on the models that you build, or if you want to leverage some partners to bring this digital journey to the customers. Yep.
It's not really a question. It's more for you. You can answer to if you feel free to answer it.
Yeah.
It's more, let's say, a fear that I have. Since you are an insurance company, you are collecting data, and I feel that one day maybe only rich people will be able to pay for insurance. I mean, we say, okay, so this guy is unhealthy, so we say, okay, you can be insured, but you have to pay a lot. If he doesn't have the money, he won't be able to be insured.
Yeah.
How can I be sure that this will not happen?
So I was mentioning this point initially. It says that using AI to segment customers at a very granular level is not something which is ethic, because then you're putting aside some people that could have been insured, but then you're putting a very high premium for them. And I think the core value of data and AI lies in the making sure your processes are very lean, that you're leveraging all the digital capabilities that you have to make sure that the cost that your management costs are quite low compared to your competitors, and then you can still mutualize the risk. And so on this point, I think there should be some there are some regulation on the fact that we cannot reject some risk. For example, in some cases, we cannot use specific variables to choose whether we accept or not a person to insure a person. So there needs to be some regulation, and it's But I think the core value is we should focus more on improving our fraud, like for example, fraud detection, improving our cost for managing, for example, managing a network of garage for cars. It's something which costs a lot, because we are sending cars to garage, and then we're receiving some invoices, and we pay the garage. So that's how it works. But there are if we use the data to identify which partners we should work with, try to see what are the good garage or good hospitals, where should we send a claim based on the severity context, or based on the location, on pictures of the damaged car, for example, where we have been able to, based on the picture, to assess the severity of the damage, and then we say, okay, we are going to send an expert on this case, or we directly send the car to the garage and we pay. We don't want to spend too much time on this small case. All of this is the highest cost for an insurer. It's the management cost. So sometimes it's outsourced to TPAs that are managing the claims for you, but in some cases we manage it ourselves. And for me, data shouldn't be used to in an unethical way to segment customers, to put very high premiums to people having because that's I think the core of insurance is mutualization, and we shouldn't forget that. Otherwise, we just if you say to a person that's your risk, that's the price, we have estimated that the probability that you will get an accident will be that, and it will cost that much. Then why should this person take an insurance contract? Maybe if we have identified at very precisely how much it will cost, then the person should just put some money aside, and you wouldn't need to take an insurance. So I think mutualization should always be at the core of our topics. But then there is still the question on privacy, because even for for optimizing internal processes, we are manipulating user data. Like, for example, in my team for telematics, we are monitoring our customers on a day-to-day basis. We are getting all the GPS coordinates, all the acceleration, speed profiles for all their trips, and so then we are building some scores based on that. And so it should be used in an ethical way. It shouldn't be used to say, okay, you're going to get a high premium. In our case, we are not increasing the premium. We are just providing some discount to the persons who drive in a nice way, and then for the rest, they will get the premium that they would have got on other insurers. So that's an example of.
So you are collecting this GPS data in real time in your telematics
Yeah.
app, and then you are analyzing it.
Yeah. And so in fact, we started this telematics platform at the beginning of the lab. It was a core component of the lab, and now we have 30,000 policies that we manage on a day-to-day basis, and we have recorded more than 100 millions of kilometers of trips. So and then we are publishing some scores. There is some kind of a gamification for the end user who see, okay, you have been you were over the speed limit on this part. Be careful. We are trying to analyze if the person is going too fast on the green or red lights in towns. Trying to analyze how the person behaves in towns, in countryside. So there are a lot of things we can analyze from this data. And we should always think about what is good for the customer, how you can.
What variables you are using with this GPS data?
So we are basically we collect the raw data, which is the GPS speed and acceleration data that comes either from some dongles that you put in the car, that we send some connected components to the person. He put it in the car, and then we process that. Or we have some partnerships with a PSA, for example, where we directly get the data from OEM from the cars, and we don't need to. And so we are analyzing some fleets of car from PSA to, and we are collecting we get every trip on a day-to-day basis. So it's a huge amount of data, and then you need to make sure that all the data pipelines work correctly. So it's interesting, but what is more interesting is the use case you can drive from all this data, because just collecting data and for the sake of it is not worth.
So we believe that the point to your question is that does self-regulation work? Because you need to trust the insurer. I mean, we trust you, and we trust, but it's at a certain point someone might do something a little bit naughtier. So yes, insurance is about risk mutualization, but some people might go very, very much in understanding what is my specific risk profile. So it didn't work with Facebook. Facebook, I mean, it didn't work. I mean, it's self-regulation hasn't worked. Maybe insurance companies are more ethical, but I think we will need to have regulation, serious regulation, because the temptation is very high. That, I mean, to put people in different buckets, it's normal, you know. It's if someone doesn't stop it, that could be a clear, could be an outcome. So we need regulation. We need as for example in my study showing that the regulator is still thinking in silos, and banks and insurances are not. I mean, it's not that they are completely overlapping, but they are becoming closer. Because in this way also the regulator has to understand that, I mean, this is a potential outcome. And then becomes a political problem. It's not anymore business. It becomes a political problem. Sorry.
Well, thank you very much for this great presentation. I was recently in an event, IBM event, and it was a workshop about the related topic, and we had a small debate about the fear of customers when it comes to granting a loan or credit. And we discussed many anecdotes, like for example, the spelling errors in the letter wrote by the customer to grant a credit can be taken into consideration to give him a customized offer. And there is a real fear, I guess, for customers, like despite the fact of correcting the algorithms and the bias, do you do any effort to reassure customers and to build trust, because this is becoming a real problem and this fear is becoming bigger and bigger?
It is in fact, I mean, I was telling Margherita that it's so big that, I mean, I have won a grant, as I was telling you before, to study how decision-making of customers change vis-a-vis digital technologies. I mean, this is uncharted territory. We are using, and I didn't say, I mean, I'm guest editing 2 special issues in Academy Management Discoveries and California Management Review, exactly to discuss, to have a platform to discuss whether the received wisdom still applies in the digital age. Now, many people are just extrapolating what we knew from the past and say, okay, it applies also in the digital age. But I mean, I think we start accumulating evidence that there are some systematic tipping points that, I mean, makes things quite different. So how is it exactly the same to buy an insurance policy from Arnaud or from a bot? It's not, I mean, that trivial. And what are the biases that kicks in at the micro level? If they are systematic, then we need to change completely our regulation, our commercial policies. It's a serious story. That's why we need a lot of research, conceptual but also empirical, to start accumulating evidence of what are these changes.
Yeah, and inside of AXA, we did tons and tons of studies of how using this specific data could improve the risk assessments. And for example, when you're buying home insurance, so usually you give some information of your age, the size of the building, or but there are lots of other variables that could give information of the risk, like just using the geolocation of your home, you are able to drive a lot of information on the age of the building, the whether to predict the risk of theft. We saw that if the person is close to a police center, then the risk of theft is lower. So there are tons and tons of data you can ingest and correlate with some personal data that are really improving the risk. And we did this study, and we were able to to drastically improve the performance of the risk models. But then at the end, we started to go and to see the agents of AXA that are selling the product to customers, and at the end it was decided to create some much more macro segments of this geographic model, because it wasn't fair. And for example, somebody could get a price at location A, and 50 meters further for the same apartment, he could get a different price. And so we decided not to put in production such type of a very granular model, even if it was bringing, it would have brought us better assessment of the risk. And then, but so there are always decisions that have to be made inside of data-driven organizations, and there are tons of use cases where we could that could serve as examples.
If there are no other questions, so thanks to our 2 speakers. Yeah. Thanks, Gianvito, for joining us. Thanks, Arnaud, for the discussion. Thanks for you that you stay till 2 o'clock. So now we have a short cocktail outside if you wanted to join us. And the next, I remind the next event, the next seminar is on November 26 with Yoon Lim from MIT. And we'll consider more the impact of AI on the design. So thanks.